Yes, welcome to the class. Today's class, we are going to see the basics of balance sheet and how to prepare a balance sheet from the trial balance, given trial balance. Okay, so balance sheet, what is the meaning of balance sheet? What are the important components of a balance sheet? Why balance sheet is called as a balanced sheet? And what is the importance of preparing a balance sheet? All these things we are going to see in the particular presentation. Okay, now coming to balance sheet. Balance sheet is one of the important financial statements which is a part of final accounts. Balance sheet is the snapshot of business assets. That is, assets means what it owns on a particular day, and liabilities, and that means what it owes to others on a particular day on which that balance sheet is prepared. It is a financial statement which shows the financial position of a firm or entity on a specified date. Generally, it will be end of March 31st on that particular day, particular year, which is balance sheet is very helpful in identifying the financial soundness of the firm. Who will be using the balance sheet? Same many stakeholders of the business who are interested in knowing the financial strength and weakness of the business will be actually looking into the balance sheet of the business. So we are actually going to see a simple format of a balance sheet and how to prepare balance sheet from the given trial balance. Component, okay, let us first go into the details of what are the important components of a balance sheet. There are three important components will be there in all balance sheet. One is asset. Asset means anything that has value and owned by a business. Next item is liability. Liability is a item which provides actually a list of debt a company owes to others, which are actually categorized same as asset into current liability and long-term liability. Next important item is owner's equity. This is the amount invested by the shareholders, which consists of equity, reserves, or retained earnings, and net profit of the business. Now, balance sheet actually is shown here as pictoriously. We can represent the balance sheet like this. The both the sides you can see it is balanced. One is on the side left hand side, which is an asset, and the right hand side is actually capital and liabilities put together, which has to be balanced together. Okay, what are the assets? And the assets on the one side, assets of the business on the one side has to be equal to the liabilities and capital put together. What is the meaning of this? Why assets should be equal to liabilities and capital? All these things we are going to see. That is why a balance sheet always should balance. Okay, when we look into the popular equation of the balance sheet, which is asset equal to liabilities and equity. Why should it be balancing on both the sides? Because whatever the company uses as asset are those items which will provide economic benefit to the business. What is that economic benefit? Economic benefit means from the asset, or the assets will be useful for deriving benefits. How it will be useful for deriving benefits? The assets are the one from which which will be from which the organization will actually get benefit or get revenue or income with the use of the assets. The assets will be useful for actually manufacturing and for converting them into saleable products and services, saleable goods. That is why assets are known as the items which will give economic benefits. So assets of an entity may be financed from internal sources or from external credits. Okay, what are the internal sources? Internal sources are share capital and profits. That is the equity part of this equation. And external credit is bank loan or any other people who can lend money to the business to run the business. That comes the equity part. And the equity part is the shareholder part, and the liability part is the bank loan and the creditors part. Okay, that is how the assets are actually financed. That is, the assets are actually bought with the use of capital provided by the shareholders and the lenders. That is why the equation is derived. Asset equal to liabilities plus equity, and the assets are the main important component of the business from where the business derive economic benefits by means of producing and selling them in the market. That is the main part of the balance sheet. Balance sheet's equation accounting balance sheet is actually formulated based on the accounting equation asset equal to liabilities plus equity. Now coming to the components of the balance sheet. Balance sheet components are majorly classified into three important aspects. One is asset, second one is shareholders equity, third part is liability. What are the components of asset? Assets are again classified into current assets and long-term assets. Current assets and long-term assets, and liabilities also same way classified into current liability and long-term liability. Okay, long-term means in a business sense, long term refers to those items which will actually come for a longer period of time. Longer period refers to more than 1 year period. Current here refers to short term period. Short term period refers to less than 1 year period, within 1 year period. So in that way, current assets refers to those assets which can be converted into cash or equivalent within 1 year period of time are known as current assets. And current liabilities are those liabilities which are to be paid or which are to be met within a period of 1 year. Long-term assets are also known as fixed assets. From fixed assets, you can derive benefit for a longer period of time, that is more than 1 year period of time. Long-term liabilities means those liabilities, that is debt components or any other debt component by means of bank loans or any other debt component which can be actually useful for a longer period of time. We can pay back the items or liabilities of even for after 1 year period of time. That is the meaning of long-term liability. Okay, so now let us look into asset. So you can see current assets. The components of current assets mainly comprises of cash and cash in hand, cash at bank, marketable securities, that is investment made in short-term securities. Then accounts receivable. Accounts receivables means the debtors are the goods which are sold on credit basis are known as accounts receivables. Then the prepaid expenses. If we have paid the internet bill or telephone bill for a 1 year period together, those are known as prepaid expenses, and from which we will derive benefit for a longer for 1 year period of time or for the given period of time. That is why they come under current assets. Now coming to long-term assets or fixed assets, they can be classified into two items. One is tangible item and another is intangible assets. Tangible assets are land, building, office equipments, vehicles, furniture and fixtures, computers, etc., from whom you can derive benefit for a longer period of time, or these assets are useful for a longer period of time. Intangible assets are those assets which does not have any physical existence but will be actually giving benefit to the business as intangible assets. They are softwares, goodwill, patents, copyrights, franchisee, trademarks, etc. These are the intangible assets. Most of the tangible and intangible assets actually will be recorded into the balance sheet, and they will be actually their value will be recorded on the book value, and which will be actually recorded with the depreciated value also. That depreciation part we have already learned in the depreciation aspects. So for tangible assets it is known as depreciation. For intangible assets it is known as amortization. Now coming to liability. Liability is an obligation that a business owes to someone, and its settlement involves the transfer of cash or other receivables. Okay, liability is also current liability and non-current or long-term liabilities. Current assets includes cash items, uh, sorry, current liabilities. We are talking about current liability. Current liabilities includes the current short-term loans in the form of either short-term loan itself or bank overdraft or accounts payable. Accounts payables are those items which are purchased on credit basis. So that items we can make payment later. That is why they are known as accounts payables. Then some of the accrued expenses, that is for those expenses we can pay later, that is salary payment which will be made after that month is over, only the salary payment will be done. That is one accrued expense. Then the tax which has to be paid, all those insurance premium, all those expenses which will be paid on a later date, but for the time period, that is known as accrued expenses. And the long-term liabilities include long-term bank loans, mortgages, if any, long-term funding from funding agents, and other type of debt components, including bonds and debentures. Now coming to the equity part of the this thing, that is the major capital component. That is, capital means the money owned or invested by the owners of the business. Owners can be either the direct owner if it is a sole proprietorship, or shareholders who are the people who have contributed to the business betterment of the business as investors. And if any extra investment is done on during that period, and as well as if it is a existing business, the retained earnings and the net profit, which will also will be form of the capital. So this is a sample balance sheet. What are the items will come under the balance sheet, which is shown here. Okay, you can see first main part is top title of the balance sheet. The title should actually will be written as balance sheet of so and so company on the particular date. And the left hand side, there are different format with which balance sheet can be prepared. For our understanding, we will take a simple format. In this, on the left hand side, liabilities are shown, and right hand side, assets are shown. Okay, so on top of the on the top portion, we are showing the long-term liability and long-term asset, and the bottom portion, we are showing the current liability and the current asset. You can see there are many items which are included in the long-term liability. Owner's equity in amount, drawings if any which has to be deducted, and retained earnings has to be shown as amount, net profit, extra investment during that period, and then comes the long-term liability, long-term loans if any, and bonds and debentures if there are any other component which can also be included. Then coming to this will total up the total long-term liabilities. And asset side, fixed assets. Fixed assets are generally long-term assets are fixed assets. So land, building, plant and machinery. So generally for plant, machinery, etc., furnitures, etc., the amount will be deducted with the depreciation amount for that particular year, including for vehicles, computers. Then comes the intangible assets, patents, goodwill, copyrights, franchisee, trademarks, etc. Then total of the total fixed assets. This need not be equal, because our balance sheet equation is assets, all the assets put together will be equal to liability plus all the liabilities plus the equity. Okay, so owner's equity. So when we come to the current liability, short-term loans, accounts payables or creditors, accrued expenses, bank overdraft, salary payable, rent, electricity bill payable, taxes payable, and the total of the owner's equity and the total liability should be equal to total of the fixed asset and the current asset. This is the format of the balance sheet. Now going to the question, the previous earlier question which we have done worked out for the trading and profit and loss account. with the same problem, we are going to work out the balance sheet also. So I've actually explained the problem in the previous slide itself. Miss Krati started business on 1st January 2017 with cash of 25,000, furniture of 5,000, goods of 10,000, and machinery worth 10,000. During the year, she further introduces capital of 10,000 by opening a bank account. So the first, all these items comprises of assets, and then this 10,000 is a current asset in the form of cash at bank. Okay, we are going to prepare the balance sheet with this additional information also. So this 1,250 is the goods drawn by the owner for the private purpose, and charge depreciation on furnitures at 10%, on machinery at 20%. And debtors and creditors are shown 35,000, 17,500, and stock in trade, closing stock is 12,500. And with this and with the data provided in the table, we are going to prepare the balance sheet. So the title, balance sheet of so-and-so company on March 2018. Okay, on the asset side, let us start with the asset side. Fixed asset, furniture, it's actually 5,000 in the beginning itself, less depreciation at 10%, works out to 500. That comes to amount of furniture, the asset value of the furniture comes to 4,500. Then comes the machinery. Machinery is 10,000, which is given in the problem, less depreciation charged at 20% on 10,000, 2,000. That comes to the value of the machinery is 8,000. So the total of the fixed asset comes to 12,500. Okay. Now coming to the current asset, cash in hand 10,000, which is actually given on the table. Cash at the end is 10,000. Closing cash balance is 10,000, which is given in the data sheet. So cash in hand 10,000. Cash at bank 10,000, which is given in the table. She further introduces capital of 10,000 by opening a bank account, that is cash at bank 10,000. Debtors is given as the additional information 35,000. Stock is also given as additional information as 12,500. Okay, that way will stop there, and then come to capital. Capital is 50,000, as I've told you already, and additional capital invested is 10,000. Net profit. This net profit we are transferring from the profit and loss account. We have prepared in the earlier this thing video 18,150. We have straight away transferred from the earlier calculation. And less personal drawings 1,250. 1,250 in the form of goods. Next one, in the in the data sheet, it is given drawings 1,200 per month. This is a drawings in the form of cash. So that drawing has to be deducted from the capital amount 1,200 into 12. So that comes to 14,400. So the total this thing will come to 62,500. The total of this one after deducting this 14,500, this 400, this comes to 62,500. Then comes to the current liability. We have only creditors as 17,500. So this total up to 80,000 here, and on the asset side also 80,000. So our asset side and the liability plus the capital side is equal to 80,000. This satisfies our balance sheet equation. With this, we have completed the preparation of the balance sheet also. I hope this will be useful for you. So we'll meet in the next class. Thank you.